Welcome to Consortia Small Business Accountants, Measuring Business Performance, Increased Financial Position, Profit, Cash Flow, and Equity. By way of introduction, this session introduces how financial statements communicate business performance. Now, to give you a little analogy here, so let's say, for example, I'm looking at my instrument panel. You'll notice here this belongs to a GT3 RS. This is a Porsche GT3 race car. It's a legal race car that you can drive on the roads. But the point being made here is that it literally is a race car. You can take it to the track on the weekends and take it to the office Monday through Friday. The point I want to make is that if you're driving a high-performance car, or any car, there's some information you need to know. And the instrument panel here obviously provides you a lot of information, some not so much as far as being important every time you drive, some things very important every time you drive. For example, how fast you're going. That's important. As far as your RPMs from your tachometer, that's important. How much gas you have in the tank so you can make it to the office, that's important. And so the point being made is that very few of us ever drive a car without referring to our instrument panel and getting information. Well, again, that's exactly what you do when you own a small business. Small business owners should not be accountants unless they have an accounting firm. But the point is that we don't anticipate that you're going to become experts in financial statements. However, we believe that every small business person, as good as they are at providing services and products, should have a basic understanding of financial information. In other words, they're the ones that are going to be making the key decisions. And so it's very important that they have the overall feel and the overall information as well as to how well their business is performing. So let me introduce you to what we call the four primary financial statements. Number one, the statement of financial position or balance sheet. Number two, the statement of income or the P&L, that is the profit and loss. Or three, statement of cash flows or cash flow statement. And four, statement of owner's equity or owner's equity statement. So if you're wanting to know the overall business performance, how we're doing, these are the four statements you need to have a basic understanding and understand the information being provided to you. So let's talk about each one. So obviously, number one, the statement of financial position. And by the way, we use these terms because it says what it is and what it does. So in other words, what does it do? It communicates to you your financial position. Number two, the statement of earnings. What does it do? It communicates your profit or loss for a period. Number three, the statement of cash flows. What does it do? It states your cash flow and the source and uses of that cash flow. Number four, statement of owner's equity, obviously addresses the equity that you as the owner have within your organization. So let's talk about each one. And again, I'm not going to take too much time here. I just want to give you the 30,000-foot view and understanding. So the statement of financial position. A statement of financial position, also known as the balance sheet, is a financial report that summarizes a company's assets, liabilities, and equity at a specific point in time. So in other words, if I'm looking at my financial statement, it's going to tell me my financial condition as of the end of the first month or a month, the end of a quarter, the end of a year. So on a given point in time, whatever the date is on the financial statement, as of that day, again, whether if it covers a quarter or a month or a year, this is where I stand as of that day. It measures what the company owns, assets, owes, liabilities, and its value, equity. The statement enables a small business owner to understand their company's financial position and helps them make informed decisions. So let's talk about each one. Assets. Assets are resources owned by the company that have a future economic value. Examples would include cash, accounts receivable, inventory, and property, plant, and equipment. One of the things you might want to know about a financial condition, or excuse me, a statement of financial condition or a balance sheet, is that it's issued in the order of liquidity. In other words, the most liquid thing you have is cash. So what's the first line item? Cash. And what's the next line item? Accounts receivable, so on and so forth. As far as liabilities, these are obligations of the company to others representing debts or amounts owed. Examples would include accounts payable to vendors, salaries payable to employees, loans to debtors, and deferred revenue. So, for example, you're an attorney, you take a retainer, but you haven't earned it yet, and so it's called deferred revenue. In other words, revenue that you anticipate, but you haven't earned it yet. Equity. The small business owner's stake in the company calculated as assets minus liabilities. It represents the residual interest in the assets of the company after deducting liabilities. So let's take this for example. The idea then is that let's say that you have a house or you're just buying a house. And let's keep it simple. Let's say it's $1 million house. You're required to put 30% down, so $300,000. And so as of the day that you bought the home, got your mortgage, what does your financial statement say just on that home? It says you have an asset, the home, valued at $1 million. It says that you have a debt, your mortgage, $700,000. And then you have, obviously, the asset less the debt equals your equity. So in other words, $300,000. So the point being made here is that that's what a balance sheet is, and that's the information provided to you. So as far as a statement of financial position or a balance sheet, let's say for the year ended December 31st, 2025. So we take our assets minus our liabilities, and it equals equity. So let's move on to the statement of income. An income statement, also known as a P&L or a profit and loss statement, is a financial report that summarizes a company's income, expenses, and profit and loss over a specific period. Whereas a balance sheet states, what's my financial condition on this day? A profit or loss statement or an income statement tells us what was our profit or our loss over this month, over this quarter, over this year. So for a specific period. The statement enables a small business owner to understand their company's operational performance and profitability and helps them make informed decisions. So again, let's go through an income statement very quickly. So as far as income, it could also be called gross income or total income for the period, the month, the quarter, the year. Income is revenue generated from the sale of goods or services during the period. So if I provide accounting services and I want to know what my revenue was, obviously from the accounting services provided. Expenses. Expenses are the cost incurred by the company to generate income, such as cost of goods sold, operating expenses, that is rent, salaries, and utilities, and interest income. So these are all expenses. So then we have, of course, what we call our profit or our loss, which can also be called net income or loss. So profit or loss is calculated by subtracting expenses from income. It represents the company's profit or loss, again, for the period. Now, as far as a statement of income, again, very simply, for the year ended, so from January 1st, 2025 till December 31st, 2025, this was our income, these were our expenses, and thus this was our profit or our loss. Statement of cash flows. A statement of cash flows is a financial report that summarizes the cash inflows and outflows of a business over a specific period, categorized into operating, investing, and financing activities. So as a small business owner, you should know that there's only 3 ways to get cash into your business, either through operations or investing or through financing activities. And so that's why it's important that over a period of time we sit down and say, okay, where did our cash come from? And obviously, a very solid company, for the most part, generates their cash from operations, from your income and expenses, from your profit, for example. That's a strong business. If you're having to rely on financing activities, you're constantly getting debt. Now, if it's a brand new business, maybe that's not so bad. But overall, that's not the best place to fund your business. The statement enables a small business owner to understand how their company generates and uses cash and helps them make informed decisions. So, first of all, when you look at the cash flow statement, it begins by talking about cash inflows and outflows from operating activities. So again, we break into those three categories. Operating activities are the core operational activities that generate income and expenses. In other words, the income revenue and the expenses from a cash standpoint. What was our cash inflow for the period, for the month, for the quarter, for the year? Okay. And so obviously we expect that to be positive because a positive cash inlay or inflows obviously is better than those that are outflowed, especially of course from operations. Now, cash inflows and outflows from investing activities. So investing activities are the sale and purchase of long-term assets such as property, equipment, and investments. So, for example, if I happen to be operate an excavator, very expensive piece of equipment, okay, and so as time is moving on, I'm growing, getting something new, whatever the case may be. If I sell that excavator, that's going to be an inflow of cash. If I buy a brand new excavator to replace it, that's going to be an outflow, okay? And so again, based on investment activities in your business. Now, when I say investments, say for example, you have excess cash, so we would suggest you put it in a CD, you put it in a higher interest rate account, these kind of things, as well as other instruments, depending on your cash flow and where you are, okay? And so you typically don't sell property equipment to fund the business. On the other hand, obviously it's not unusual. In other words, you want to know where did that cash inflow. So it's one thing to say, hey, gee, I had some nice excess cash flows from investing, from our investing activities this year. And so if it came from investments, that tells you one thing. If it came from selling property or equipment, that tells you another. Cash inflows and outflows from financing activities. Financing activities are activities related to debt and equity financing, like borrowing money, repaying loans, issuing stock, and paying dividends. So when it talks about related to debt activity, okay, we're talking about the balance sheet, debt. So that would be borrowing money or repaying loans. Borrowing money would be an inflow of cash. Paying loans would be an outflow of cash. Whereas when we talk about equity financing, we're talking about obviously issuing stock. In other words, if I'm wanting to raise money by selling a portion of the business to bring it on a partner, whatever the case may be, I'm going to issue some stock. On the other hand, if I'm paying dividends, it'll be an outflow. So again, identifying these things and understanding these things are important. So again, as far as how the statement of cash flows works, again, for the year ended December 31st, 2025. So for that year, we began the year on January 1st of 2025 with this much cash in the bank, your operating account, for example. Now, we had some cash flow from operating activities, hopefully. And if it was a profit, it was a plus, it increased our cash. If it was a loss, it most likely decreased our cash from operating activities. And by the way, obviously, the most important sources of cash should come from operating activities. And then, of course, cash flow from investing activities, we had some inflows, we had some outflows. And then as far as cash flow from financing activities, again, we had some inflows, we took on some debt, we had some outflows, we paid the principal on the debts. And therefore, overall, what was the increase and or decrease in cash for the year? And therefore, what was our cash at the end of the year? So if we started the year with a good cash number and we increased the cash, obviously our cash in the year is going to be higher. If we decrease the cash due to one of these three activities, then obviously our cash position will be lower. So the statement of owner's equity. A statement of owner's equity, that is the statement of changes in owner's equity, is a financial report that summarizes the changes in the value of the owner's stake in a business over a specific period. It details how the owner's equity, which represents their investment in the company, has increased or decreased over a period due to various factors. The statement helps the owner to understand the overall financial performance of the business from the owner's perspective. Okay, so we're going to start with what's called the beginning equity balance. So again, let's say December 31st, 2025, we're going to begin the year with so much equity. Now, we can go back to our example about buying a house and the equity we have. Well, we have the equity in our business, okay? And so how do we begin the year? Then we have throughout the year, we may or may not have, depending what type of company you have, depending on how many owners you have, we have owner contributions or what's also referred to as investments. So the owner contributes or invests our additional capital invested by the owner into the business during the period. And that's going to raise, obviously, your equity. Then you have net income, or that is profit or loss. So net income or loss is the profit or loss generated by the business during the period. And then we're also going to have owner withdrawals or distributions. So from time to time, again, depending on what type of business you have, how many partners or owners there are, you're going to take withdrawals. So owner withdrawals, or what's referred to as distributions, are any funds or assets taken out of the business by the owner during the period. And of course, then we determine our ending equity balance. And obviously, we're wanting our equity to always be going up, okay? And so ending equity balance is the final value of the owner's equity at the end of the accounting period. Again, the month, the quarter, the year. And it reflects all changes. So again, statement of changes in owner's equity. We began the year on January 1st with an equity balance of X. And then we made some owner contributions. We contributed some contributions into the organization, typically cash, for example. So it made the equity go up. On the other hand, when it came to net profit, if we had a net profit, it would have increased the equity balance. If it was a loss, of course, it would decrease the equity balance. And then, as I stated, if we have any withdrawals, taking money out of the organization, then that's going to decrease our equity balance. So the question then is that as of December 31st, 2024, our equity was this. And of course, that's what we began on January 1st of 2025. So then the question is, as of December 31st, 2025, what was our ending equity balance? Did it go up or did it go down? If it went up, that's great. That's what we're expecting. We want our ownership, our equity, to go up. If it went down, depending on the situation, that's not good overall, but it may be okay. But the question is, why? Why did it go down? Why did it go up? And then you go back to look at what contributes. Was it because of no or too much owner contributions? Was it because of no net profit or, loss? Or did we take out? So that's the point. You analyze this and determine, why did my equity go down? Because overall, again, you don't want it to go down. So as far as financial statement information, the four primary financial statements provide you a clear picture of your company's financial performance, strengths, and weaknesses. Knowing your company's financial performance, strengths, and weaknesses enables you to capitalize on your strengths and improve your weaknesses. You improve your weaknesses by identifying them and developing and implementing strategies to improve them. Now, of course, when we work with our clients, always giving them those strategies to help them improve their financial position, their profitability. their cash flow, their equity. So that's just a brief introduction. Okay, I didn't want to overwhelm you today. And so the idea was to go through and introduce you to the four primary financial statements. Now what we're going to do is get more detailed. So in session 2, we're going to talk about the statement of financial position, how we increase financial position. Session 3, we're going to talk about statement of income, how we increase profit. Session 4, we're going to talk about statement of cash flows, how we increase cash flow. In session 5, we're going to talk about statement of owner's equity, how we increase owner's equity. And again, the idea is to help you build a high-performance organization. And high-performance organizations are constantly improving their financial position, constantly improving their profit, constantly improving their cash flow, constantly improving their owner's equity. That's how you describe a high-performance business when it's performing and increasing each of those items together. Thanks for attending. Have yourselves a wonderful day.